The global crypto market entered the early months of 2026 with some extremely deep and painfully frustrating corrections. Since the peak back in October 2025, many major coins have lost nearly half of their value, and more than 2 trillion United States dollar in total market capitalization have been wiped out in a very short time. Bitcoin, the pillar that usually leads the market, was no exception. From the peak of around 126,000 United States dollar in October, by early February 2026, it had dropped at one point below the psychological level of 60,000 United States dollar. And what is concerning is that a 50% drop might not even be the end of the story. This was not just a regular profit-taking wave. It was more like a convergence of multiple forces happening all at once. Widespread liquidation of leveraged positions, rising expectations that United States monetary policy would take a more hawkish turn, and even new fears around technological security, like the ongoing discussion about quantum computing. In this video, I am going to break down the biggest factors that have been hitting the Bitcoin market in particular, and the crypto space in general, over the past several weeks. Alright, let's dive in and take a look at each of these factors one by one. Reason number 1. Deleveraging in the derivatives market. The crypto market dropped at an unusually fast pace during the beginning of 2026. From January to early February alone, more than 1 trillion United States dollar in market capitalization evaporated. Many called this the full capitulation mode. In simple terms, the market entered a panic surrender mode, where every time a support level broke, automatic sell orders kept getting triggered one after another. At the core of this issue was the derivatives market. By the end of 2025, leverage had piled up heavily, which was reflected in the open interest, or OI for short, representing the total value of open futures contracts, which had exceeded 90 billion United States dollar. A high OI meant the market was carrying too many leveraged bets. So when prices started to weaken, it was easy for a chain reaction to occur. As the price started to drop, the process of deleveraging kicked in. To put it simply, the market was unwinding leverage through forced liquidation. Liquidation means that once your margin drops below a certain threshold, the exchange automatically closes your position and sells off your assets for you. When too many long positions get liquidated at once, it creates what is known as a liquidation cascade. Prices drop, positions get liquidated, the system sells off more. Prices drop further, more liquidations follow. That is why some of those red candles fall so quickly, it looks like someone just stomped the chart down. Data also shows a massive leverage flush. In just the first week of February, open interest dropped from around 61 billion to 49 billion United States dollar, which is more than 20%. But that was not all. The crash was even worse because big money did not step in to stop it. The Coinbase premium, the price difference of Bitcoin between Coinbase and Binance, kept turning negative, at one point reaching negative 167.8 United States dollar. In simpler terms, institutional or United States-based money was showing signs of selling or pulling out, while retail investors kept trying to buy the dip. That made the market even more prone to further drops. Reason number 2. The macro shock from the Fed. If many once believed Bitcoin was disconnected from the stock market, 2026 has proven the opposite. Bitcoin now moves more like a risk asset similar to tech stocks. When investors are feeling bold, it rises. But in times of fear, it drops hard. For instance, when the Nasdaq or S&P 500 sinks over a few days, Bitcoin often tumbles too, sometimes even more sharply because of its extreme volatility. And once it is viewed as a risk asset, what really matters is no longer crypto news, but the actions of the Federal Reserve. Even just the expectation of a rate change can shift money flows across the market. The worst shock hit at a highly sensitive time. On the 30th of January 2026, President Donald Trump nominated Kevin Warsh to replace Jerome Powell as Fed chair. Warsh is seen as hawkish, someone who focuses on fighting inflation and supports keeping interest rates high and tightening policy aggressively. But what shook the market was not only interest rates, it was also liquidity. That is why everyone began talking about quantitative tightening, or QT. It means the Fed is pulling money out of the system, basically turning down the money faucet. With less liquidity, crypto, which is very volatile, feels the pain first. Meanwhile, the Fed signaled no rush to cut rates. At the end of January 2026, they held them at 75%, and said more cuts were not coming soon. The message was clear. Easy money is not coming back quickly. There is also growing talk about the neutral rate, the level where the economy is balanced, not overheating or shrinking. If that turns out to be higher than expected, today's rates might become the new normal. That would make the higher for longer scenario even more likely. And when that view takes hold, investors pull back from risky bets. Bitcoin, like a high beta tech stock, gets sold off harder, leading to deeper and longer lasting drops. Reason number 3. The AI trade starts to crack. Throughout 2025, one of the main narratives fueling the crypto market was, AI and blockchain are the future. Anything related to AI was getting high valuations, including Bitcoin mining companies. But by early 2026, that so-called AI trade began to fall apart. Investors stopped buying into the story and started asking real questions like, we are throwing piles of money into AI, where are the profits? A clear example came from Alphabet, which announced its capital expenditures for 2026 could reach between 175 to 185 billion United States dollar, almost double that of 2025. This kind of spending number made the market nervous about burning too much cash, which put pressure on big tech and AI-related stocks. As the AI trade slowed down, it hit Bitcoin miners directly. Many big miners in 2025 had rebranded themselves as compute infrastructure companies, shifting to renting out electricity and server clusters to support AI and HPC. HPC, or high-performance computing, simply means renting out computing power and data center infrastructure to AI models. The problem is, once people started questioning AI profitability, the money and lending conditions for AI and HPC projects also started to dry up. Meanwhile, Bitcoin prices weakened. Miners found themselves stuck. Their operating costs continued day by day, borrowing money became more expensive, and raising new funds got harder. So, what is the fastest way to get cash? Sell some of their Bitcoin reserves. But when miners sell, it is very different from when small retail investors sell. It creates spot supply, actual coins hitting the market at a time when the market is already fragile, which pushes prices down faster. This is a key difference from previous cycles. In the past, miners used to hold on to their Bitcoin longer. But in this phase, they have become a significant source of selling when they need cash, adding heavier spot supply pressure. Reason number 4. Governance and political risks. In a panicking market, what scares institutional investors the most is not just falling prices, but legal risks and conflicts of interest. Right at that moment, WLFI, a crypto project linked to President Donald Trump's family, came under scrutiny for its lack of transparency in ownership and cash flows. In early February 2026, the Wall Street Journal reported that an entity tied to the royal family of the United Arab Emirates had agreed to purchase 49% of WLFI for 500 million United States dollar, just before Trump's inauguration. Soon after, Representative Ro Khanna, a Democrat, opened an investigation and sent a letter demanding documents about WLFI's ownership structure, payments, and policy ties. Simply put, for institutional investors, foreign money flowing into a project connected to the president's family was already a red flag. What made it worse was the suspicion of a quid pro quo where that investment could influence policy, especially on issues like AI chips and UAE tech firms like G42 or MGX. Whether or not the allegations hold up, the fact that Congress is investigating was enough to raise red flags in the market. And when risks like this show up, crypto markets tend to respond in a very straightforward way. They demand a higher risk premium. That means investors want lower prices before they are willing to hold anything. Everyone knows that if this escalates into a full-blown legal or ethical scandal, the fallout could go far beyond just one project. It could bring more scrutiny, tighter regulations, or wider uncertainty for the entire industry. In short, WLFI was not the cause of a sudden Bitcoin crash like a liquidation wave, but it did chip away at confidence at a time when the market was already fragile, giving institutional money even more reason to stay out or cut back, making the downturn harder to recover from. Reason number 5. Fear of quantum computing. In February 2026, this topic gained major attention due to growing fears that quantum computers might one day break the current encryption model behind Bitcoin. In the past, this was mostly seen as theoretical. But by the end of 2025, advancements in quantum hardware stability and AI-powered error correction made people begin to view this as a technical challenge with a deadline, meaning it no longer felt like something that was decades away. According to a report from Chaincode Labs, around 20 to 50% of all Bitcoin currently in circulation could be at risk if a quantum computer powerful enough to run Shor's algorithm were to appear. The main vulnerabilities lie in old P2PK wallet addresses from the Satoshi era, where the public key was directly recorded on the blockchain. There are three major risk groups that worry people the most. Satoshi-era wallets with around 1 million Bitcoin, where the public key is fully exposed. Reused addresses holding about 4 million Bitcoin or 25 to 30% of the total supply, where the public key becomes exposed after previous transactions. The broadcast window of every new transaction, because the public key becomes visible while waiting for confirmation. The total value at risk could be somewhere between 240 and 650 billion United States dollar, depending on the strength of the quantum computer. Even just the fear that Satoshi's 1 million Bitcoin could be stolen creates enough psychological pressure to make a price drop last longer. To prepare for this, a testnet called Bitcoin Quantum was launched in January 2026 to experiment with PQC algorithms based on NIST standards, like MLDSA, also known as dilithium. But to fully implement these, Bitcoin would require a major soft fork, and the hardest part would be community consensus and the risk of a chain split. Other contributing factors. Aside from the 5 main reasons I just mentioned, the market has also been dragged down by several other factors. These may not have started the crash, but they acted like extra weight pressing on an already compressed spring, making it harder for prices to rebound and easier for sentiment to snap. First, there is the shrinking of stablecoins. Normally, when people sell Bitcoin or altcoins, the money stays in United States dollar T or United States dollar C, waiting to re-enter. But this time, data shows top stablecoin supply is contracting. That means money is exiting crypto altogether into fiat or safer assets. Without fresh stablecoins, there is less ammo to buy the dip, so each drop sees weaker buying support. Second, the risk-off wave from traditional markets. Crypto is no longer isolated. When stocks, especially tech, go defensive, funds usually cut risk across the board. And highly volatile assets like crypto get sold first to reduce margin, cover losses, or raise cash. That is why sometimes, even without any bad crypto news, prices still fall because big money is rotating. Third, institutional defensive moves, ETFs, options, and hedging. When investors load up on put options or pull out of ETFs, it signals that large players are bracing for impact. These moves may not crash prices directly, but they shake retail confidence. The market shifts from buy the dip to sit and wait. Lastly, big event-driven sell-offs. In fragile conditions, just one headline about a massive wallet dumping billions, or an old address moving coins to an exchange, can trigger panic. And because crypto is heavily sentiment-driven, these signals, though not the root cause, often accelerate the wave of selling. In short, the early 2026 crash was not random. It was caused by a reversal of liquidity, leverage unwinding, shifting Fed expectations, and risk-off flows. Derivatives then triggered further liquidation, while the AI trade collapse, regulatory fears, and quantum computing concerns piled on. And most importantly, this is not new. Crypto runs in cycles hype, leverage, and painful resets. So here is the message: zoom out. A price drop is not always an opportunity. Sometimes it is the market adjusting to new risks. If you plan to buy, do it with a strategy, allocate in parts, manage risk, and survive first. Do not let buy the dip turn into an excuse to go all in or use leverage when the trend is still against you.